You know that feeling when you finally have your first $1,000 saved up and everyone's telling you to invest it, but you have absolutely no clue where to start? Yeah, I've been there too, staring at that money, wondering if I'm about to make the smartest decision of my life or completely mess everything up. Well, today, I'm going to walk you through exactly how to invest that first $1,000 without losing sleep over it. And I promise, by the end of this video, you'll have a clear roadmap that actually makes sense. Let's be real for a second. The investing world can feel like everyone's speaking a foreign language, throwing around terms like diversification and expense ratios, while you're just trying to figure out if you should put your money under your mattress or take a chance on the stock market. But here's what nobody tells you about investing your first $1,000. It's not about picking the perfect stock or timing the market like some Wall Street genius. It's about building the foundation for your financial future, one smart decision at a time. Before we dive into where to put that money, we need to talk about something that might save you from a major headache down the road. That $1,000 shouldn't be invested if you're still carrying high-interest debt like credit card balances. I know it sounds boring compared to potentially making money in the stock market, but hear me out. If you've got credit card debt charging you 18% interest, paying that off is like getting a guaranteed 18% return on your investment, which is better than what most professional investors can promise you. The same goes for your emergency fund. I get it. Keeping money sitting in a savings account feels like watching paint dry when you could be investing it. But you need at least a small emergency cushion before you start investing. Even just $500 set aside for unexpected expenses can prevent you from having to sell your investments at the worst possible time when you need quick cash. Now, assuming you've got those basics covered, let's talk about where that $1,000 should actually go. The beautiful thing about starting with $1,000 in today's market is that you have access to investment options that would have cost way more just a few years ago. Thanks to fractional shares and low-cost index funds, you can build a diversified portfolio without needing tens of thousands of dollars. Here's my recommendation for most beginners. Start with a broad market index fund. I know that might sound complicated, but think of it this way. Instead of trying to pick individual winning companies, you're basically buying a tiny piece of hundreds or even thousands of companies, all at once. It's like getting a sampler platter at a restaurant instead of betting everything on one dish you've never tried before. A total stock market index fund gives you exposure to the entire U.S. stock market, from big established companies to smaller growing businesses. The fees are typically very low, often less than 0.1% per year, which means more of your money stays invested and working for you. Over the long term, the U.S. stock market has historically returned about 10% annually. Though remember, that includes both good years and bad years. But here's where it gets interesting. You don't have to put all $1,000 into stocks. In fact, you probably shouldn't. A simple approach that works well for beginners is to split your investment between stocks and bonds. Bonds are basically loans you make to companies or the government, and they tend to be more stable than stocks, but with lower potential returns. A common starting allocation might be 70% stocks and 30% bonds. So that would be $700 in a stock index fund and $300 in a bond index fund. This gives you growth potential from the stocks, while the bonds help smooth out the ups and downs. As you get older, you might gradually shift more toward bonds, but when you're young, time is your biggest advantage in investing. Now let's talk about where to actually open your investment account. You've got several good options, and the differences between them might matter more than you think. If your employer offers a 401k with matching contributions, that should probably be your first stop. It's essentially free money, and you can often start with as little as $25 per paycheck. But if you don't have access to a 401k with matching, or you've already maxed out the match, then you'll want to look at opening an individual retirement account, either a traditional IRA or a Roth IRA. The Roth IRA is often the better choice for younger investors because you pay taxes on the money now, but then all your future growth and withdrawals in retirement are tax-free. For your first $1,000, I'd strongly recommend sticking with one of the major discount brokers like Fidelity, Schwab, or Vanguard. They all offer commission-free trading on stocks and ETFs, have excellent low-cost index funds, and provide educational resources to help you learn as you go. The differences between them are honestly pretty small when you're just starting out. Here's something crucial that most people get wrong with their first investment. They put the money in and then check it every single day, watching it go up and down like they're tracking a sports score. This is a recipe for making emotional decisions that will hurt your returns. The stock market goes up and down constantly, sometimes dramatically, and that's completely normal. Your $1,000 investment might be worth $900 next month, or it might be worth $1,100. Neither scenario means you should panic or get overconfident. Successful investing is boring. You put your money in a diversified fund, you ignore the daily noise, and you keep adding money regularly over time. Speaking of adding money regularly, this is where the real magic happens. Let's say you invest that initial $1,000 and then add just $100 every month after that. After 10 years, assuming an 8% annual return, you'd have about $37,000. The power isn't just in that first $1,000, it's in building the habit of consistent investing. One mistake I see beginners make is trying to be too clever with their first investment. They'll read about some hot stock tip or the latest investment trend and throw their money at it hoping to get rich quick. The reality is that successful investing is about time in the market, not timing the market. That boring index fund approach I mentioned earlier has beaten the majority of professional fund managers over the long term. But what if the market crashes right after you invest? This is probably the biggest fear most new investors have, and it's understandable. The truth is, market crashes happen regularly, and they're actually opportunities if you're investing for the long term. During a crash, you're essentially buying shares at a discount. The key is having the patience and discipline to keep investing even when things look scary. As you continue your investing journey beyond that first $1,000, you'll want to gradually increase your knowledge and maybe branch out into other investment options. But for now, focus on building that foundation with low-cost diversified index funds and developing the habit of regular investing. Remember, the goal isn't to get rich overnight with your first $1,000. The goal is to start building wealth consistently over time while learning about investing in a low-risk way. That $1,000 represents the beginning of your financial independence, not the end goal. The most important step is the first one. Stop overthinking it, pick a simple diversified approach, and get started. Your future self will thank you for taking action today rather than waiting for the perfect moment that never comes.